Right now we have activities in over 60 countries around the world. We provide a little over $25 billion a year in financing for those supply chains. The Czech Republic has always been a very attractive marketplace for us because there's such a pool of talent here in terms of the human resources. It is from a political perspective, it's been a very stable and resilient environment. It's got some very interesting and exciting companies here. For the head of sales at a supplier, simply stated, they want to get cash from their customer as quickly as possible. And how to bridge this gap between one person that wants to extend and one person that wants to accelerate is what supply chain finance does. And then one day out of the blue, they called me into the office and said, Tom, we'd like you to move to Australia. Would you be prepared to do that? Well, I think I was 27 or 28 years old. It took me about half a second to go. Move to Australia sounds like a pretty good plan.
Welcome to Business Lab podcast. This episode will be entirely in English because we have a guest from the United Kingdom, and it's Thomas Dunn, the chairman of Orbian. Welcome.
Thank you, Arnold. Thank you very much indeed. It's lovely to be here in Prague today, just spring day. It's beautiful to be over here, and thank you for having me.
Yeah, it's great to have you here. I've invited you because Orbian acquired last year Roger. But before we dive into that, let's talk about your personal story, your career, because I talked also with your colleagues, and it seems to be really a great story. So for our listeners who haven't had a chance to meet you or to check your LinkedIn profile as I did, could you briefly summarize how your career went? Because yeah. I heard you spent some time in Tokyo and all around the world, basically.
Yeah, sure. Thank you. So I was born in the second UK city of Birmingham, which is a place that it's not as familiar to everybody as London, but it's a beautiful city, and it's a place that very proud to come from. And it's a city with a couple of very good football team, so we're very happy with that. I studied in the UK and then went to college, and then from college I went straight and joined JP Morgan, which was back in 1987, and it was then known as Morgan Guarantee Trust. It was the old heritage JP Morgan organization. I had the pleasure of working for them in London for 5 years, right at the beginning, and traveled a lot to Scandinavia. To Copenhagen, to Stockholm, and particularly to Helsinki, with a kind of working as a junior banker covering Scandinavian clients. And then one day out of the blue, they called me into the office and said, Tom, we'd like you to move to Australia. Would you be prepared to do that? Well, I think I was 27 or 28 years old. It took me about half a second to go. Move to Australia sounds like a pretty good plan. So a few weeks later, I was on a plane to Melbourne and lived in Melbourne for 2 years, where we started to develop a debt capital markets business for JP Morgan down there. After a couple of years down there, I moved up to Sydney, where I carried on building out the debt capital markets platform. Did a lot of work in the early years of securitization in Australia. And then I was given kind of increasing amount of responsibilities in Australia for the different trading businesses that JP Morgan had down there. And was very happy, and by now I'd got married and had 3 young children, and we were getting well settled in Australia. When the Asian credit crisis came through in 1998, this was when there was a sort of a meltdown in the local market economies of much of Southeast Asia. And it was starting to ripple up into the Japanese economy as well. The Japanese bubble had burst. The banks were starting to come under a bit of pressure. And the JP Morgan asked me to move to Tokyo to take over responsibility for the bank's credit businesses for the region. So we packed everything up and we moved from Sydney to Tokyo. Arrived in 1998 and lived there in Tokyo for 4.5 years, which was incredible. It's an incredible city. It was an incredible place to live and to do business. But in 2000 and towards the end of 2000, of course, JP Morgan was acquired by Chase Manhattan Bank. And that necessarily led to a variety of changes in the organization and in the way that the businesses were structured. And so in early 2000 late 2002, early 2003, I left the bank and moved back to Europe, where I set up a investment management company called Raglan Capital, which has since then has been the kind of the vehicle for various investments that I have made, that have continued to kind of develop a theme of banking and credit, and that's kind of then where the Orbian journey started. So that's kind of where we got started there.
Okay, that's a very impressive story. Thank you for sharing it. So now that we got to Orbian, maybe it's a great time to explain our listeners a bit what Orbian does. Can you do it like without getting too technical?
Sure.
Because our audience is mainly from business, but sometimes it's easier to understand like in simpler terms.
Sure. So first of all, the background to Orbian, which is kind of sort of important because it set out the DNA for the company. Orbian was originally founded in 1999 as a joint venture between Citibank and SAP. And if you like, that has been the DNA of the company ever since. We're not a fintech. We are a technology-enabled financial services company. And there's a very important distinction there because what we do is we provide financing for the working capital needs of the global supply chains of typically large investment-grade companies operating all around the world. Right now, we have activities in over 60 countries around the world. We provide a little over $25 billion a year in financing for those supply chains. And what we are doing is allowing buyers and suppliers to optimize their respective working capital requirements. And in order to do that, we have a variety of tools that we use that we deploy to allow people to meet those requirements. But it's all based around the starting point of the buyer, the customer's credit rating or credit capacity, and then the liquidity needs of the suppliers. So that's how we go about it. We do it. We operate principally out of London, the United States, and Germany. We have a team of people that is dedicated to just doing this one particular field and doing it in a way that we believe and we're kind of acknowledged and rewarded year after year as being the best in the world at this particular aspect of working capital finance.
Wow, okay. Thank you for the introduction. It seems like a really global business, so it's great to talk about that. And let's also cover your role a bit. You've been a chairman since 2006, if I'm not mistaken.
Yeah.
What does your role actually look like? What do you do from day-to-day basis? And has it changed over the time you started?
Yes, absolutely. So that's so. When I came in, I think the biggest priority that we had at the beginning was reorganizing the company in order to get it from a rather heavily loss-making position into a position where it was at least cash flow break-even. And much of my early efforts were devoted to two things. One was acquiring new clients that would drive the revenue side of the business, and the other was leading an effort that was going to reduce our costs in order that we could level out that balance that by 2007 had become an intolerable cash drain on the investors in the business. So that was kind of in the early years. I was all about it was a bit like, although the company by then was 7 years old, or by in 2006 or 2007 it had 150 employees. By 2009, it had 20 employees. We had completely re-engineered the way that the company operated, and that had been my principal responsibility. Had been making sure that we narrowed that gap, we eliminated that need for, and so that had been the piece. Since then, my responsibilities, or the way that I really devote myself, has become ever more. I have a handful of clients that I stay very, very close to. But I'm very much focused on kind of, if you like, the strategic elements of the company. So for a while, we had a large Japanese bank that was a shareholder. I've been involved in negotiating their entry, and in the last couple of years, negotiating their exit from the business, from the cap table of the business. I spend a lot of time on recruitment of the senior level managers of the business. We're very, very privileged now to have 7 managing directors that operate the business across the globe. They do an absolutely fantastic job, and frankly, they can do, they can completely run all aspects of the business, including increasingly now the strategic elements of that as well. But that's how I spend most of my time now.
Okay, sounds like a great role to have, and also. It seems that you are surrounded by very smart people, so I believe that's enjoyable. So I did a bit of research, and it seems that in the history of supply chain financing, the Green Seal collapse in 2021 was like the changing moment, and you were very vocal and defending legitimate supply chain financing.
Yep.
What do you think Green Seal did wrong, and did it influence your business?
That's a great question. So, Green Seal Capital had been set up by a guy called Lex Greensill, who I'd known for a number of years. I'd known him when he was first at Morgan Stanley, then when he was at Citibank, and he is a very smart guy. He's a very charismatic figure who had been an early adopter of supply chain finance. He left Citibank. He set up Green Seal Capital with an aim of further developing these various instruments. And here we have to be a little bit careful because his trial starts in the UK in a couple of weeks' time.
Okay.
Where he, but the essential, I think the fundamental issue was that he had 2 sides to the business. There was one side which was supply chain finance, which unfortunately was a rather small component, and didn't provide him with a sufficient platform to become a billionaire very quickly, which was a goal that he had. He was very public about, stating that he had ambitions to become. And unfortunately, supply chain finance, as we kind of practice it, is not really a business that is going to, over time, one can grow out of business, but it's not one that can rapidly accelerate into that. So alongside the supply chain finance activities that he had a variety of other activities that drew in a lot of capital, particularly from the Vision Fund of SoftBank, that was used to provide the sort of the equity financing for a scheme that rapidly ran very substantially, I would say, out of control in terms of financing entities that were not fundamentally creditworthy, and that it was tied up with some retail funds from Credit Suisse in largely out of Southeast Asia, and with credit insurance from an insurance broker in Australia, and that the whole structure just got way too big and way too uncontrolled far too quickly because of the ambitions that the company had for itself, and it demonstrated quite clearly that one needs to distinguish between hyper-scalable fintech companies and scalable but not hyper-scalable. In other words, you can grow a credit business at 15, 20, 25% a year and retain control of it. You can't grow it at 300% a year, or else it just starts to the controls that you require around the credit qualities just break down. And so, but that's not to say that if you have a technology business that's just providing technology to people, that's fine. If you're actually providing finance to people, then it's very important to retain all of these controls and this measured level of growth.
All right, so it seems like a standard problem in finance, like someone's a bit greedy maybe and doesn't consider all the risks properly. But yeah, it seems that it hasn't influenced your business that bad.
We were quite fortunate to the extent that a few of us in the business knew the problems that were underpinning Greensill's world 2 or 3 years before it actually finally collapsed. And that gave us a chance to make sure that the message was out there and some defense mechanisms were put in place for the day when it would ultimately collapse. So that as far as the legitimate supply chain finance components were concerned, which probably accounted for less than 5% of his total business activities, when the announcement came in that they had gone out of business, we and a handful of other firms, in particular UBS and JP Morgan and UniCredit, were able to step up and fill the gap extremely quickly over the course of a weekend. And that ensured that there was no lasting damage done to the supply chain finance industry as we kind of understood it. So, in fact, it was the expression that I used. It was a boil that needed to be launched. We needed to get rid of the issues that were there, and in fact, it got resolved extremely well by the industry that was well prepared for that day when it was inevitably going to come.
Okay, that's great to hear, because I remember, for example, a parallel from the crypto world when FTX, the cryptocurrency exchange crashed, like the whole industry was down. So it's great that this is a different story.
Yeah.
So maybe let's switch on a positive note. I'm kind of interested in your bank pool funding model.
Yeah.
That's something you talk about as a real differentiator. Why should your clients care whether their SFC program is funded by one bank or many, or many banks plus institutional investors? Is it something they should genuinely care about?
Absolutely it is, because we go back to the founding principle of what supply chain finance is trying to do. And as I said a few minutes ago, what we're trying to do is enable buyers and suppliers to meet their respective working capital goals. So if you like, for a buyer, for the procurement officer at a buyer, the mission is to extend their payment terms as far as is reasonably possible. For the head of sales at a supplier, if you simply stated, they want to get cash from their customer as quickly as possible. And how to bridge this gap between one person that wants to extend and one person that wants to accelerate is what supply chain finance does. The crucial piece of that then, to build resilience around that relationship, is to make sure that you're not reliant on a single source of financing. And that's why having multiple banks or multiple different types of funders is very important. But it's not simply enough to say the program has a lot of different funders, because you can have lots of different funders, but if each of them is funding one particular supplier, then that particular supplier will still be exposed to that particular funder. So you have to kind of consider things in terms of what we would say is the word of fungibility, so that the suppliers, every supplier is funded equally by all of the different, and it's just a pool, and there's a pool of liquidity that comes in. Now, what this requires and relies on is Orbian acting as the balance sheet that sits between the buyer and the supplier. So there are 3 separate relationships in our programs. There is the buyer that is approving the invoice. There's the supplier that is selling the receivable, and there is the funding partner that is financing the transaction. But each of those three is kept kind of like, if you like, contractually separate. And this is a very important distinction between Orbian and all of the other supply chain finance providers, because most of the others are acting as a technology interface that is linking a bank with a supplier. Well, if you link a bank and a supplier, then that supplier is still now reliant on you, on the particular bank. Whereas with Orbian, it's this complete pool of liquidity that is made available.
So maybe one more follow-up question would be, I saw in a GTR interview you predicted that within a couple of years, most of the funders of supply chain finance program would be hedge funds and insurance companies. That's a bit surprising to me. So what's driving this?
You're absolutely right that it's a bit surprising. And, sometimes one is just wrong. It's... Back in 2023, 2024, there was a big upsurge in interest from non-bank providers, and particularly from the newly establishing credit arms of whether it's the insurance companies or of the multi-strategy hedge funds that were looking at trade finance generally and supply chain finance in particular as being a very attractive asset class. Over the course of the last 9 months, we've seen that trend reverse itself extremely quickly. And it's really reversed itself on the back of a single incident, which was a US company called First Brands Group, which has gone rather spectacularly bankrupt, leaving about $12 billion of liabilities that it had incurred through supply chain finance arrangements unpaid. That was a company that had been very heavily supported by these new emerging credit funds that thought they saw an opportunity to earn 12, 14, 18% returns out of short-dated, self-liquidating assets. All of the characteristics that we have often said are what makes supply chain finance a very interesting asset class. But at these kind of returns, there was a big signal that was being, or a big smoke signal that was going up, that this may not be everything that was that it wasn't necessarily exactly what it was saying on the label. And indeed, this was the case. And unfortunately, this has just led to a big withdrawal of liquidity that was otherwise being provided. So I'd say that as of today, we are yet more reliant on the banks than we have been for the last couple of years, and that's fine because there's some very good appetite there amongst the banks and amongst some of the long-standing insurance company providers of capital into the sector.
Maybe let's talk now about Roger, a company that you acquired in Czech Republic. You said in the deal announcement that Orbian had been watching Roger for 5 years.
Yep.
So what were you looking for? What was the decision factor that made you to pull the trigger?
Okay, that's a great. So I was first introduced to Adam Sukal, the founder and CEO of Roger. I think we first met back in 2018 or so, and we got together a couple of times. We exchanged some notes. We talked about some joint business opportunities that we started to explore together, and then the pandemic came, which kind of necessarily disrupted things a little bit. And then through that, none of those things really came about. We liked each other. We sort of thought there was a degree of complementarity between the businesses, but nothing that was really triggering anything substantial. And this was still in the days when kind of there was a lot of energy, of hype around. It was still in the days of Greensill Capital and the valuations on supply chain finance activities and everything else. And what happened then in shortly after that was that Roger sold 25% of their company to KB, the Czech subsidiary of Société Générale. And they went off, and that was great. Adam and I stayed in touch, but there was under an understanding that really now that they were going to be working more closely with Soc Gen, and that was kind of. We Fast forward to late 2024 or August 2024, and SocGen or KB and Roger sort of decided that it would be better for them to that SocGen was keen to sell down their shares. Roger was quite keen to buy those shares or to see those shares transferred to somebody else. Not that anything had gone wrong in the relationship, just it was kind of like it had played out its course. So Adam called me and said, I think the KB shares might be for sale. Would you be interested? And I said, well, I really like you and I really like the business, and I've seen kind of the way that you've developed it over the last 3 or 4 years, and that looks fantastic. But to be honest with you, Adam, I don't really have any interest in buying 25% because I just don't think that kind of leaves everybody a little bit. What I would be interested in doing is buying all of Roger, because I really like you and I really like the business. And so then we had a discussion about it. He was like, yeah, but I still really kind of believe in the growth of the business. I said, that's great. We'll do that. And you can, as part of the compensation for the part of the purchase price, I'll give you shares in Orbian. And so this is what we did. So over the course of the next few months, we negotiated a transaction that saw us buying out KB and one other institutional VC investor for cash, and then for Adam and the other founders, and for one somebody that had been there as an investor from the start, we issued them shares in Orbian in return for their shares in Roger. And so we ended up with a perfect combination, the situation where we now acquired 100% of Roger, so we can integrate everything. We can really have the two companies work together entirely without a feeling that one side is gaining an advantage that the other side. It can just all be very much integrated. And the KB and the other institution got what they wanted, and they got paid out at a nice return on their investment, and the others got to take shares in Orbian, and it was an exceptionally constructive set of discussions that led to those, and that's then carried on in the year since then in terms of the way that we've actually now decided to work together on the businesses.
It sounds like everything just went smoothly, but I'm sure there were maybe some hard parts of the deal, and also Roger was profitable back then. Partly owned by a bank, which acts kind of like a due diligence, maybe I would say. So that brings me to idea, like, was there anything hard or any like considerations that went into that deal?
That's... and maybe there's an element here where I'm going to get, so nothing hard or bad has happened yet. So is there something that is waiting to bite me around us? Because you know what, I have to say we had an exceptionally smooth process through this. The negotiations around the valuation were extremely straightforward. Adam and I, over the course of some early discussions, set out the parameters for that, and everybody stuck to that. We were helped very much by the fact that both companies are nicely profitable. So there was no question about someone having to adjust for the losses that were going to become profits at some day in the future. SocGen, KB kind of stayed out of they were happy with the price that they were offered, and they then didn't need to get involved. The regulators could not have been more constructive and more supportive in terms of helping. Now that's largely because of the reputation that Roger already has with their regulators, and so they were operating there in terms of being highly credible actors with them. But that worked extremely well. Orbian has the benefit of we are regulated. We have some regulators of our own, so that provided us with credibility with the Czech National Bank in terms of the regulatory environment as well. So those pieces all worked extremely well. But I think that a very important part then of kind of what's happened subsequently is that we have really concentrated on our efforts on the people that are at Roger and that are at Orbian. And we've really worked very, very hard to make everybody feel part of one team as quickly as possible. There's no sense in which the acquisition was seen as a way to replace one system with another system, or no way in which it was seen as clients would be moved from one platform to another platform. The whole thing was really based around the combination of skills and expertise that sat on both sides of the table, and we worked extremely hard. Even well before the deal had closed, Adam was and a couple of his senior managers were working very closely with the Orbian leadership team. Were very much being kind of socialized within that group. That became a very important component of the way that we built out the company afterwards, and that we gave everybody in the organization confidence that this was an opportunity for them to thrive and to kind of move their careers to the next levels, as opposed to ever being something that needed people to go into a defensive crouch about how they were feeling about their roles or their responsibilities.
Yeah, and I think you managed well. I spoke with a few people from Roger, and everyone seems to be excited that Roger is part of Orbian now. And I'm also curious because you've already mentioned Czech National Bank, but CE is much larger. There are a number of companies you could have bought instead of Roger. There are Polish companies, Slovak, Hungarian. What was it that you saw here?
Well, I think that first of all, we shouldn't underestimate just that so much just comes down to personal, the personalities and the relationship, the serendipitous relationship that I developed with Adam was, the heart of this, sat at the heart of this transaction. So that was extremely important. The Czech Republic is a very attractive, has always been a very attractive marketplace for us because it is. There's such a pool of talent here in terms of the human resources. It is from a political perspective. It's been a very stable and resilient environment. It's got some very interesting and exciting companies here. It sits at the heart of, as we think about kind of forward-looking. It's got a disproportionate role to play in the European defense industry, which is extremely exciting for us, maybe for the wrong reasons, but let's just think about this commercially. And so we, that's the way that we thought about the Czech Republic. But then, as we just look at what's happened in the last 9 months or so, and we look at the way that Poland is a phenomenal economy. Now with the change of politics there, it's looking even more exciting. You look at Hungary again, just in the last 3 weeks or so, the opportunity that presents. So there's the Central European economies as a group are an extremely exciting, and we're delighted to have a company that already operates with such a degree of credibility, and now the opportunity for us to think about potentially further acquisitions or partnerships within this region is we've got the perfect platform now from which to think about that.
Mm-hmm. All right, it's nice to hear that because some people complain that life is hard here, but mostly they just can't even compare it to other countries. Yeah. So it's nice to hear that. And when you talk about how Roger's people and Orbian's people connected, it got me thinking, is there anything else in terms of maybe business model or technology, what Orbian gets to Roger and vice versa, what Orbian can learn from Roger as an agile, fast-moving fintech?
So 2 things there. First of all, there are some things that Roger does in terms of its business model, in particular around what we call accounts receivable financing, as opposed to what Orbian does with the accounts payable. And that was something that was attracted us to Roger in the first place, that they have this, and it's a technology, it's also a skill set within their staff that was very attractive to us. The second thing is that we are going through, Orbian has been working on had a multi-year project of a modernization and upgrade of its core operating platforms, and through Roger we were given an introduction to another Czech company headquartered in Brno called Moro Systems that has now become our partner in the development of that, which is something, to be honest with you, it's a shame that we wouldn't have discovered Moro Systems without Roger, because they are fantastic. But it took us actually having the relationship with Roger to introduce us to Moro. But that has been a very important element of that. I'm not sure that there's been quite so much going on the other way round from a technology perspective yet. But what there has been, in terms of flow from Orbian to Roger, has been some of the applications that we have built around the customer service models that we provide, and a number of new client leads that we've been able to provide to Roger that they have successfully executed on. So in fact, the acceleration in Roger's financial performance since the acquisition has been truly remarkable, and is a real testament to the underlying business strength that we knew was there.
Yeah, I believe so. I also had Adam on the show, and it was also fascinating. Great to hear that also from your side.
Yeah.
We are getting to the end of our interview, so maybe to wrap this up, I want to ask you, 3 years from now, what would success in C look like to Orbian? Like, do you have any number of new clients you would be happy with, or any specific plans that you can already share?
No, I wouldn't specify it in terms of number of new clients. I think that what we would like to do over the next 3 years is establish ourselves, consolidate our position as the leading supply chain or working capital finance solution for companies across the Central European region. In the same way as we look to carry on building on our success in the United States, in Germany, in Southeast Asia, where we already have very substantial presence, and we see with Roger, unquestionably, we have the right platform to do that. Now it's a question of executing into that client base.
All right, I'll be following that story, and wish you best of luck.
Thank you very much indeed. It's been a real pleasure being here with you today. Thank you very much indeed.
Thank you for coming to our show, and until the next time.
Thank you.